Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, each and every week we come to you with very many different ways that you can hear or see the show. First thing I'm going to talk about is YouTube. YouTube is a great thing, by the way. You can record on YouTube. You can get your message out any different way that you can, and the more you use it, the more people get sent to it. My YouTube channel is called Jeff Barton, the Mortgage Voice. Go there. You can see this radio show. You can see my weekly LinkedIn or my Facebook or my Instagram 1 minute. They call the Mortgage Minute, which is really 5 minutes. Anyway, all of these things are ways by which you can get caught up on what's going on in the mortgage industry. The radio show, of course, is every Friday and Saturday on 5 different radio stations. But back to YouTube. Go there. Join up. Sign in. There's a lot of people doing that right now because the market is volatile. Things are happening. There's a lot of changes in both, not only the rate, but are we going into a recession? What's happening in the real estate market? All of these things you can get caught up. Go to YouTube, Jeff Barton, the Mortgage Voice. Sign in. Say you like it. And we'll get you notified as to when the next show appears. Anyway, I am Jeff Barton. This is The Mortgage Voice, and thanks very much for tuning into the show. In thinking about what I was going to talk about today, and there are some things to talk about, the main topic I think that's happening worldwide and how it's going to affect you and your decision, meaning what's going to happen to rates. How is that going to be affected if prices come down? If prices come down, i.e. the real estate world starts to slow down a little bit and we start to get more of a volume in the marketplace, meaning more houses in the market, is this going to help me? The question is it going to help you? Okay, so last week we talked about being simple, looking at the payment, looking about what you pay on a monthly basis and what you're going to be able to afford. Focusing in on that, not the larger, bigger pictures. This week is kind of a what do they call it? One fits into the other, whatever that's called. Do you know what it's called, Daryl?
Sounds like it's
Yeah, maybe a little bit. Yeah. So if you dovetail one into the other, exactly right, you will see that because of the fact that mortgage interest rates have not fallen and probably won't fall, the continued emphasis is on whether you can afford that particular mortgage. Now, if there are more houses in the market, that's a good thing. However, is it a good thing if those houses keep going up in price? Because that's what's happening. A couple of things I wanted to talk about exactly what's happening. The median price of home in the U.S. is up 10.8% year over year. Now, is that a good thing? No, it isn't, because what happens is, as mortgage interest rates go up, so do the cost of homes, which means fewer and fewer people can afford it. That's not a good thing. However, last 2.5 months ago, year-over-year prices went up 21%. So we see it coming down, but not coming down fast enough. We see, however, interest rates on your loan, yeah, they're going up. And they're going up because people are afraid about the recession, the big R word. What is happening in your neighborhood? What is happening with your job? You know, there's a sentiment out there right now, not the Michigan sentiment, but another sentiment about unemployment. And people who have jobs think that the employer has more of an upper hand in negotiating your particular salary than they have. 73% of the respondents said that. Now, it flies in the face of the fact that we've got full unemployment, well, not full unemployment, 3.5%, but they usually classify that as full employment, and we have 10 million jobs going unfilled. There's a great fear that that number is going to crash, that what we're going to see is a lot of companies laying people off. Now, if you're in the finance world, if you're in the mortgage world, if you're in the banking world, you're already seeing it. But that's a function of the rising interest rates on loans and also the inventory being very low on housing. Even though we have seen 30% more houses on the market now than there were last year, it's still at historic lows, about 2.5 months of inventory in the system. We have seen home sales slow down, obviously. Sales down 20.2% year over year. That's not great. That's not great, because if we have fewer sales and there's more properties on the market, how come we haven't seen prices drop, right? Because of the pent-up demand that the system has been trying to shake out for the last year and a half to 2 years. And that's what's happening in the marketplace. That's what's going on with you when you're looking and you're searching for a house out there in the marketplace. 30-year interest rate, 5.73%, 5.01 for the 15-year, 5.12 for FHA, 4.90 for the jumbo, and 5.88 for the 5-1 ARM. That ARM product, it's hooked up with the 2 years. We always say 3.26 is the 2-year bond, and the 10-year is at 3.061. Now, the 10-year has gone over 3%. And, it's funny. 6 weeks ago, we were talking about a quarter point as a big inversion, and that inversion means that the 2 years yields you more than the 10-year, and that inversion usually gets in front of what the recession is going to be. So if you have an inversion like that, and you had it 6 weeks ago, quarter point was huge, and oh my God, everyone was crying that we're going to be in a recession tomorrow. Well, now it's back down to a quarter point, and everybody talks about the flattening of the yield curve. It really is about perspective, especially if you watch, and this is a weekly show, so I get to think up some things to talk about. Imagine being on some of these shows on a daily basis, especially CNBC, Bloomberg, Fox Business, you name it out there. The people that cover business on a daily basis, they've got to come up with things to say every single day. And because business is what it is, yes, there's volatility, there's CEOs you can bring on, there's stock prices, there's all things you can consider, but come on, after a while, it's pretty cyclical. You see the same thing over and over and over again, and that's why I say, when they're talking about the yield curve as something 1 week, and the next week it's something completely different, when in fact the yield curve is still only 26 basis points, it's really not that big a deal, and wasn't. Although, as I said in the past, if you have a yield curve like this, you're going to see a recession, and we may still see a recession. I just don't know. 72% of recent home buyers have regrets. Okay, I had a sale in the area that I live, and we live in Southern California, and the area this sale was down in South Bay. About 6 weeks ago, put the property on the market, and there was some dancing around and trying to figure out what the best way to particularly market this particular property, whether it was, paint and clean it up, whether it was to redo or all the things you do when you're trying to get the most and best out of your property. You're trying to figure out, okay, what do I have to do in order to get the highest, best price? In this changing marketplace, I told the seller, I said, look, you need to sell this property now. You need to price it so you can sell it now. Don't try to get the highest and best. Get what you can right now. And obviously that was a very good price for this particular property. But my insistence on selling the property then for the most you could get then, not wait and see if you could fix it up and get more money, was because the market is changing, and it is changing. One of the regrets of buyers, and this 72% survey that said 72% of home buyers have regrets, is a couple things. They went over and beyond what they should have, meaning they didn't have a proper inspection. They waived all of their termite inspections. They didn't have the appraisal contingency in place. Now, what a lot of people still do is they say, okay, if this is what maybe you've heard in your particular neighborhood, the seller comes to you and says, all right, it's a seller's market. I am going to sell you this property at this, but if the appraisal comes in lower than this, you've got to pay the difference cash. Now, all of these things are things that buyers currently regret. Why? Because they're seeing prices take a U-turn. And believe me, 6 to 12 months from now, you're going to see 10 to 15% reduction in prices in real estate. Now, is that horrible? No, it's a readjustment of what has been an overheated market. And obviously, we've seen prices go through the roof, as I just said. I mean, sales might be down, but median price is up. That's not a good thing if you're a first-time or any kind of buyer at all. So all of these things. One more thing, abandon shortcuts. Okay, stop cutting corners when it comes to writing contracts. Sellers are gotten so used to being able to call all the shots. This is the major regret that people have, that they cut There are particular corners, i.e., I'm going to not do the inspection. As I said, I'm going to pay the difference in that appraisal. As I said, I'm going to do things that I just wouldn't do in a more even market. Those are the two things that are the regrets. Are there more? Yes, they are. They paid too much. That's a number 3 in the terms of regrets for people who have bought properties over the last 12 months. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. You know, we are heard each and every week on 5 radio stations in 3 different states. If it's not down in Albuquerque, it's up in Las Vegas or in Tahoe or in Southern California at KCAA, KMET. We have 5 great markets we've been in for a year and a half. We're getting some pretty good feedback. But as the market changes, anybody out there listening, go to these places. You can go to K-Tahoe up in Tahoe. You can go to K-Mine at K-Mine Country down in Albuquerque, and certainly KSHP in Las Vegas, Nevada, AM 1400, KCAA, as I said, and KMET, 2 Southern California radio stations. All of them have archives of the show as well as the show that you're going to listen to right now. So I appreciate it. I do want you to sign up, tune in, each and every week, get the best information about mortgages and real estate on your radio dial. Thank you very much. I am Jeff Barton. This is The Mortgage Voice. Okay, we bring people to the show. We bring people who know a way lot more about it than I do. Justin Simpers from Orion joins us now, is no exception. Justin, how are you?
I'm all right, Jeff. How you doing?
I'm fine, thank you. I was talking to Justin just a bit off air before he got on about getting old and some of the things that fail us mightily. One of the things about a market like this that has had legs that went on for days, well, it got old fast and rates went up. And so what is it that you see the market doing, maybe continue to do, and how is Orion solving some of the problems of the change in the interest rates?
You know, Jeff, I mean, that's a good question. I feel like it's loaded. I mean, obviously the market has shifted and it's going to continue to shift to be a buyer market, not a seller market, meaning,
Yep.
you know, buyers are going to get more for their offers coming up here. And what I actually see as the hottest trend, the biggest trend is really down payment assistance.
Okay.
Down payment assistance is leading the calls. I mean, I would say 8 out of 10 calls I get are on the DPA programs, you know, that we offer. And, you know, I'm very versed in, you know, that market. I have done it on the retail side and on the wholesale side. And so I have worked with, you know, the GSAs, the Cal HFAs, or the HFA in general, and Chinoa and National Home Buyer Fund. And so I would say that is the hottest topic going on right now in our industry. It's kind of nuts, you know.
Yep.
Yeah, you know, the other hot one is investor property loans, you know, and using the rent to qualify for purchases. That's hot, but, you know, DPA has taken over. It's just, you know, DPA obviously short for down payment assistance, but
Sure.
That is just the hottest topic. I mean, I get webinar requests every day, multiple times a day, on the computer, showing people, you know, how it works and meeting with agents and all the like. So, you know, I would say that, you know, a lot of people have actually heard the HFA advertisement going on, you know, $10,000, you know, granted for closing costs and all this and that. And, you know, that comes with a lot of layers on that program. If you fit and you qualify, then that's great. You know, I'm going to smash some of the misnomers out there that people are thinking would qualify. And, you know, the biggest one is, you know, it's really for conforming balance only, you know, and there's high balance counties and there's not high balance counties. And, you know, 648-200 is, you know, let's say the Los Angeles, you know, Ventura County limit. It would be, you know, for loans that are under high balance, down payment assistance is available, but the pricing is not, you know, cohesive. It doesn't jive. It doesn't make sense. And so, for the people that are, first-time home buyers or not, they could qualify for a down payment assistance program and, stretch their qualifying needs. And so, yeah, I mean, that's the hottest topic,
Yeah,
I,
question. We've had a market previous to now, which had a lot of cash in it. Would drive up home prices. People seem to be able to put cash down, no problem. You're saying that has reversed a little bit, or these buyers that have been waiting in the weeds have finally figured out, okay, I can now safely get into a market that I can compete for a house?
Well, I think it's a multitude of both. I mean, you've had a cash influx into the market over the last couple of years that
right.
I wouldn't say has dried up, but is selective at this point. And
okay.
you now have sellers, that are motivated to sell, and not as many buyers in the pool buying at the moment. And,
right.
There's a lot of that is due to rate shock. It's due to, inventory movement. But, I would say the days of 2% are gone for the foreseeable future. I do see and if I had a crystal ball, I would say rates are a bit high compared to what they are going to be, in my opinion, in the next 12 months. I think it's going to settle back down once inflation comes back down. But
okay,
but the sellers market has gone away, and so when you were competing, and you had 40 offers on one house,
yeah.
and 5 of them were all cash, then okay, that's where it was moving. But now, you have a lot of people trying to take advantage of the equity that they're building and, getting rid of their houses, and there's not as many buyers out there. And a lot of the people that did not have the cash are finding their offers are getting accepted, and so that's what you see, and that's what we're seeing right now.
Okay, that down payment assistance. Now, there's a bit of there's always confusion with the different programs, because not only does your lender have to have it, but they also have to be hooked up with either CalHAF or a Chenoa or some of the other programs that you mentioned. Can you give us an example of one of those programs, and what would a path straightforward once they get the decision and the accepted offer to move forward with that type of loan?
So that type of loan, is, I'm not going to say it's any different with us than
okay.
it is with regular FHA financing, which is kind of the benefit. So, with those types of loans, I would fully suggest submitting what's called a to be determined underwrite, and that's the, when you're getting with your loan officer.
Yep, great idea.
Them,
yep.
All of the income, all of the assets, and having it fully underwritten, so that when you do get into contract, what conditions that you need to satisfy to fund the loan, and that's key, and Orion has been the top funder for Chenoa nationally for years, and
right.
I've had a lot of success with that program, and it's a vehicle simply meant to get the borrowers in the home, and so when they come to the table with all of their income, all their assets, credit, and they're qualified, then it makes the offer so much stronger,
Absolutely.
So, yeah, that's the key to that, and the thing is like a lot of the down payment assistance programs, like CalHAFA or the HFA, for instance, it requires a third party underwrite at close, and so that kind of can throw a monkey wrench in the deal with an HFA, and the thing with Chenoa is it doesn't, right? There's
right.
no
right.
third party underwrite. It's completely done in house. There's no credit decision outside of the lender, and so that makes for a really strong program for assurance of close, and the other thing I will tell you, on Chenoa, for instance, there's no income limits, so you could be making whatever, doesn't matter, non-occupant co-borrowers with somebody who's not going to occupy, it's going to help you qualify is fine. Those things aren't available on any other DPA, and so that combination with the quick closing is making it really, really popular. And the NHF as well. The only difference between the National Home Buyers Fund and the Chenoa is the NHF does have an income limit of 160% of the area median income of the county they're buying. But I mean, you got to take into consideration, like Southern California, that's $100-something thousand a year, right?
Yeah, yes, it is. which really qualifies you for a lot of property. Yeah.
Oh, yeah. Yeah, definitely.
Hey, listen, we're up against it right now. If you want to shout out a way by which somebody can get a hold of you, ask you about these programs, and be able to pick your brain.
Yeah, no, I appreciate that, Jeff. It's
Sure.
My email is J as in Justin, and then Simpers. My last name is S as in Sam, I M as in Mary, T as in Paul, ERS as in Sam, at OrionLending.com. And, shoot me an email. I'll be glad to help. I appreciate it, Jeff. Thank you.
Thank you, Justin. That's great information, especially in a market like this where a lot of people are really looking for some help. Appreciate the time on air, and we'll see you soon.
All right, Jeff. Thank you. Take care.
Thank you very much. That's Justin Simpers from Orion Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, you can not only see this show on YouTube, Jeff Barton, the Mortgage Voice on YouTube, but you can go to our website, themortgagevoice.com. Themortgagevoice.com is a place whereby not only you can see and hear some of the guests on the show, but you can get in touch with them directly. If you want to bypass some of the other areas that you can not only reach us, listen to the show, see the show, go to themortgagevoice.com, check in, sign up, say you like it. We'll get you alerts as to what's going on a weekly. The show is also seen every day almost on LinkedIn and Facebook and Instagram. I do a Mortgage Minute, which is really Mortgage 5 Minutes. I don't know why I call it Mortgage Minute. Probably because of the alliteration. Anyway, I appreciate that. I'm Jeff Barton, and this is The Mortgage Voice. Okay, we bring great people to the show. Once again, from Albuquerque is Mike Torres. Mike Torres is a great loan officer down there, works for Home Funding Corporation, and he's kind enough to join us and let us know what's going on down in Albuquerque. Mike, how are you?
Hey, how are you?
I'm fine, thank you. How's it going down there?
Oh, it's been really slow, but the market's just pretty much steady. But it's downgrading every month. Especially now that the winter's coming up.
Okay, tell us a little bit about the cycle of what happens in Albuquerque, so people listening will say, "Oh, okay, this isn't so out of the ordinary." I mean, does it get slow after a certain date? Do you find that it's harder to refi people because rates went up? What's happening with all that?
Yeah, basically, I had a couple of files that I was trying to refinance, but then the rates went up, and then they went up more and more and more. So right now, people aren't really refinancing, because of the rates being up to close to 5.5%, 6%.
Yep, that's right.
Depends on the refinance, on the rate in term or cash out. But we're doing a lot of non-QM loans now, so
Yep.
That's been picking up.
Now, do you do that DSCR loan, that investor loan? Is that what you're concentrating on?
Yes, the DSCR is basically using the lease agreement as your payment and your income, and that's all you need to qualify for that. Isn't that crazy?
Yeah, it is crazy. And do you see that there's still a housing crunch down in your area? I know that for a while there was, so many people trying to bid for a single house or a few houses that were on the market. Do you see that the market itself, the real estate market, has picked up in the housing inventory as well as fewer and fewer people bidding on it? I mean, do you see that?
It hasn't picked up. It's basically been really, really slow everywhere, which way. But people are paying more for a home now that it
Yep.
usually was selling for about $150, even $180,000. But now they're up at that $300,000. So it's like it's kind of really, really like what would you say, crazy
Yep.
market.
Yeah. Yeah, no, I think doubling of the median home price in Albuquerque, which Albuquerque was one of the hottest markets in the U.S. for the last 18 months. It really was. We saw people really moving from other places that had cash because they had sold their house, moving to Albuquerque and really driving the price up. It was really outside forces that made that price go up so fast, isn't it? It's not necessarily the homegrown market.
Yeah, well, basically what it is now that, people just love the weather in New Mexico.
Yeah, of course.
Especially Albuquerque. They love the weather, and, basically they like to relax and have fun. But, the market's really, really kind of like and the up and up, because it's like people are trying to buy a home, but I mean, who can qualify for a $300,000 home nowadays?
Right.
With the minimum wage being as low as it is, it's really, really hard for people to get to qualify for a home nowadays.
Now, when you qualify them, are you using any down payment assistance programs? Are you using mostly FHA? How are they qualifying with that particular price tag of $300,000?
Well, I don't have any MFA programs as we speak.
Right.
But there is the FHA, which is 3.5% down, or they can do the conventional, which would be 5% down. And if they make too much money, if they don't make, I think it's $55,000 or more, they can be able to qualify for a 3% down conventional.
I see. And the rates. Okay, tell us about the rate situation. Has it really cooled the market so much that really the only thing you're doing is down payment assistance, bank loans, TIN numbers, things like that?
Yes, basically what we're doing now is the rates have gone, they're between 5.5% to 6% interest rate for a 30-year fixed.
Yep.
And so right now we're basically concentrating on getting clients into either refinance or purchase using a non-QM loan, which is they can use bank statement deposits as income instead of 1040s.
Right.
Or they can actually use profit and loss statements from their CPA, and that'll get them qualified into a home.
Now, you and I know that back in the day, 2006, 2007, CPA letters were used quite a bit, and we had some issues with loans in that way. How are you, as the broker and the loan officer, checking to make sure the CPA letters, do they come with licenses? How does that work with the CPA letter?
Yeah, basically what it is the CPA has been doing their taxes for many, many years, and all of a sudden, the CPA has to be just licensed for the state of New Mexico.
Okay.
And certified. And what we'll do is we'll use the letter and a profit and loss statement to be able to qualify these clients to be able to purchase or refinance their home. Really simple.
Okay, well, that's good. It's good because sometimes these things can really be overwhelming for a borrower who just is going, what is that? And they don't know what a CPA letter is. They really don't know what profit and loss is. They just know they make a certain amount of money and they think they can afford a home. Going that route, do they talk that over with you before you send them to the CPA, or does it go to the CPA and then it comes to you next?
Well, no, basically what we'll do is we'll probably just do like a 3-way call.
I see.
The CPA and the borrower. That way they all understand what we're coming through and doing everything by the book.
Okay, excellent. Now, employment down in the Albuquerque area, I know that there's a lot of government jobs down there, and the income that makes is pretty fixed. I mean, it doesn't go up or down as much as some of the other places in the U.S., just simply because the jobs are steady. Do you think that the job growth or the salary growth can match where home prices are? Because that's going to be a problem in the future if, in fact, that's not the case.
Yeah, I think that the job and the income is not going to be enough for what the homes are going for,
Right.
Because we talk about $350,000 home, and you've got an average of $30,000 to $50,000 a year. That's not really much, and then we use 50% of that as the debt to income to qualify them. So it's kind of 50-50, yes, 50-50, no. If it's going to work or it's not going to work. So it just depends on each individual.
Right. What are you suggesting to buyers who come to you in terms of should they buy now? Should they wait till prices drop? What are you telling them?
I think they should buy now, and the reason is what is the interest rate on the rental property?
Right.
When you're renting,
right,
that interest rate's 100, maybe 1,000%.
No, so you're right.
Even though the rates are high, it doesn't matter. You're renting, you're throwing your money away. Buy a home, refinance. Do something to be able to get your foot in the door and own a home.
No,
throwing your money away.
Yeah, no, I agree with you. I know that in the U.S., if you want to be a rich person, you got to own a home, because the equity in your home is what really makes it, after you pay it off 20, 25, 30 years later.
And the average is that people usually refinance after 4-5 years.
Yeah,
anyway.
that's right. Right.
And get yourself into a home, and then once the economy or straightens out, whatever happens, then they can be able to look into getting maybe a refinance and getting a conventional mortgage, and maybe even getting an appraisal waiver, which means no appraisal required.
Right.
Just a lot of programs out there, but at the same time, get yourself foot in the door, get yourself a home, whatever you need to do, even if you have to move to Belen, Los Lunas, Rio Rancho, or even if you want to build a home, you can be able to do a one-time closed construction loan with Mike Torres.
Mike,
that's the thing, is get yourself in the door.
Do me a favor. Tell people how they can get in touch with you. Talk to a great loan officer down in the Albuquerque area.
Oh, yes. You can reach me at 505-307-3080. We're open 7 days a week, and we're available anytime. So if you have a question or you just have a concern, or maybe you need some credit repair or whatever, we do it all for free. We just want you to send me your family, your friends, your enemies. If anybody needs a home.
Excellent. Mike, thank you very much for coming on the show. Always appreciate it. Thanks again.
Thank you, Mr. Barton.
You're quite welcome. That's Mike Torres. He's from Home Funding Corporation, frequent guest on the show from Albuquerque. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Each and every week we come to you any number of different ways. We're on 5 radio stations, 3 different states. We're on YouTube. We've got a bunch of different podcasts that we're on. We've got a great website. The best place, and always the place to go for me, is come to my Twitter handle at Jeff6493. Now, why is it that? Well, the reason is because it's easy to remember. It's 4 simple numbers, my name, at Jeff6493. You can get the instant, updated information about what's going on. Sign in, sign up. I'll get you out right away. Anyway, I'm Jeff Barton. This is The Mortgage Voice, and I'm pleased to have you here today. With us once again, is the best in terms of what we have to offer at Malibu Funding, Charles Giscombe. He is the manager as well as the qualified employee for Las Vegas, Nevada, expert out there as well as other places around the country. Chuck, how are you? Nice to talk to you.
Thank you, Jeff. That was an awesome introduction, and thanks for having me again.
Oh, thank you very much. Okay, I'm going to say this, and I'm going to say it loud and proud. There's a lot of pessimism out there about a lot of things. And I am just kind of sick of it. I've got my own things to worry about. I want to hear people in the business that are excited about doing loans, not saying, the interest rates went up, we can't get any loans. There's a lot of things we can be doing. Tell us about some of the things you're doing in order to get excited about.
You know what, Jeff? It's so interesting that you say that, because you hear those rumblings all the time.
My.
And as I sit at a table in a circle, if I'm smoking a cigar, Jeff, on the golf course, or eating a meal, having a drink, I hear this all the time, and I really can't comment. I have to be honest. My pipeline is full through the roof, Jeff. As you know, we're working really hard. And when everyone has great interest rates in the industry, hey, everybody's doing well. The true salesmen, the true individuals that sit down, buckle down, teach their clients what it is that's going on to take away the fear and let them know that they still are able to transact are the true salespeople. Those are the people that will last the test of time. Anybody can sell an interest rate, but can you sell someone on terms other than interest rates that will still have a comfort level and a warm and fuzzy for an investor or buyer? That's what we do at Malibu Funding. That's what I try to do. So as I said before, I understand the rumblings, Jeff, but we've been super busy at Malibu.
That's excellent. No, and it's good news, too. I mean, educating the client is more than just, hey, you know what, I can get a better rate over here. No, it's about seeing what the situation is, seeing what your knowledge of 30 years in the business can actually solve the problem. You want to get this because of this. Okay, here are some of the options that we can do, and here's what we can do to help you get what you need to get. I think that's the way that anybody who's in finance, certainly in the mortgage business, has to be, especially in this type of market.
I'm completely in agreement with you, Jeff. You have to do the extra work. And, they say Einstein may not have been the smartest guy, but he might have sat in front of the problem longer than everyone else, Jeff. And I like to say that's what we do, because I know that's what I do.
Oh, that's excellent. Yeah. Tell us.
I have to sit in front of it for a while, Jeff, and I have to figure out different ways that an interest rate can't stop our flow.
Right.
We have different programs and non-QM programs and alternative programs that add different kind of terms that will counterset or offset the higher interest rate. For example, you have a non-QM loan that you can get into, 10% down or 15% down using bank statements, but they have a 40-year interest-only option that has no penalty. So now your loan is amortized over 40 years and not 30 years. And that also has no mortgage insurance. So you may be paying the same rate as a 4 or 5% loan or stroking the same monthly check as a 4.5 or 5% interest rate loan, but without mortgage insurance and having a 40-year amortization, that will get that payment down monthly to make it look or appear as a low interest rate loan. Those are just one of the many programs that are out there for our clients that still want to transact. And that's whether you're buying a primary residence or an investment property. Those non-QM alternatives are available, and we have them at Malibu Fund.
Now, we saw the jump, right? Everybody saw the jump, and we still see this volatility, this up and down with the rate. Last week or about 10 days ago, I think the rate was almost under 5%, 4.9 something. Now we're up in the mid-5s. We're going to continue to see this, right? We're going to continue to see the up and down in the conventional market. But the non-QM market doesn't seem to do that as much. Is that right?
No, you know what? The non-QM is naturally going to be 1.5, 2 points, and now even 2.5 points higher than a traditional rate mortgage.
Right.
The thing about that is it will stay consistently that way.
Right.
Obviously, it's already high. Now, the way they can offset those situations is they can lower LTVs so that you have to come in with more, and that's where they protect themselves. But as far as the interest rates are concerned, they'll be pretty consistent. They will move as the market moves. As LIBOR moves, we understand what happens, Jeff, but at the end of the day, you still can get consistently low interest rates. And once I said, and not the lowest interest rates, but there'll be consistent rates, and more importantly, there will be other options and loan terms that they can do that allow them to be more flexible so that we can transact and still have lower payments or low payments that we were used to. It's not a reason to not transact. If you have the ability to repay, there's great houses out there. What is happening is the house market is changing a little bit, and now there's not so much of a competition out there. There's still competition, and the values are still good, but it's not as much as it was. It's not a frenzy anymore. So now is a great time to jump into the market and take advantage of these programs that we are talking about right now.
Now, you talk about real estate prices. Okay, so you have your fingers on a lot of different pies or pulses or whatever you want to say, whether it's in upstate New York, whether it's in North Carolina, whether it's in Las Vegas, Nevada, whether it's in Southern California, or any number of other markets, Chicago, for instance. What do you see is happening real estate-wise in all of these markets?
Well, Jeff, honestly, I really see that the values are still there. They're still having values. Now, obviously, they're not inflated, but they're still there. They're still great properties. There's still an opportunity to make money today. Right now, there's still an opportunity to make money. So these markets, in all the places that you said, and then some, values are still good. They're not dropping. The bottoms are not falling out, and you still can make a great investment and still make some money. I think that's consistent across the country. It hasn't, the bottoms haven't fallen out yet. So I would tell anyone who is interested or maybe slightly hesitant in regards to getting into the market because they feel the values are going to drop. You still have a good value base to the end of the year and into the next. I do believe so.
Okay, recession. Let's talk the big R word just briefly because people get worried about that. And if you watch any of the news programs, especially CNBC or Bloomberg or any of these types of business channels, they're constantly harping on the possibilities or what is, what isn't. To be honest, if in fact there was a recession, wouldn't they drop the rates? Wouldn't that be good for mortgages? I mean, I'm just saying.
You know what, Jeff is cyclical.
Yep.
Like it happened before.
Yep.
When they get to a certain point and they're too high and money's not moving, they have to. drop the rate.
Right.
In order for individuals to get back into the market, to have some confidence, some economic confidence, to get back into the game, they would have to drop the interest rates, which will, once again, allow people to get back in and transact. So if it does get too high, it won't stay there because the market will be stagnant, and obviously in a recession situation, there will be no money movement. So it has to correct itself.
Right. I mean, you look at the last 30 years, let's say since 1999, when they had the dot-com bubble, and what we saw is interest rates were lowered just because we had the bubble explode and we had a lot of people that were in trouble. We had it happen during the Iraq War. We had it happen during COVID. Anytime there's some real tragic or volatile situation, some situation that affects the world in certain ways, the interest rates drop. Well, we're in a situation right now where we're looking like we're going into a COVID recession, let's just say. So if you did get into a house and then you drop the rate within 18 months to 24 months after the recession or during the recession, that would be a good reason to get into something now, wouldn't it?
I am completely in agreement with you. If you can get in, if it gets this high and it goes 18 to 24 months, you know that you're only taking this loan temporarily. And
right.
That's a lot of the reason why I tell individuals, you get an interest-only situation to make your payment lower because you know you're not going to stay in that particular interest rate.
Right.
And then all you need to do is refinance into the lower interest rate when they do bring the rates down, and you're back where you needed to be. But you were able to get into that property, not with so much competition and not so inflated, but at the value and a decent value in a home price. I think it's a great strategy. I think what you're saying is absolutely correct. And if individuals took heed to that, they would get in, and that's the hardest part is the acquisition. And now you're in a leverageable position, so you can refinance. You just need to make your payments. Make sure your credit stays pristine, and then you'll be able to go ahead and refinance into a lower interest rate and possibly refinance into a situation where you may be able to pull some of that money out to do some more investing if your property appreciates.
Excellent information. Look, we're up against it. Can you shout out a way by which people can get in touch with you?
I sure can, Jeff. Thanks for having me again. It's 702-328-5191. It's 702-328-5191, Charles Giscombe, or you can email me at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Charles, thank you very much for coming on the show. Always like the information and the enthusiasm. Thanks.
Jeff, thanks for having me again.
Okay, very good. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening, for coming to us each and every week. We have a number of ways that you can hear and see this show. One of the ways is we have podcasts out there. I don't know if we have podcast lists
we have podcasts everywhere, and I got a list.
Excellent, perfect. What are they?
Checked it twice. Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and of course the website at themortgagevoice.com.
MortgageVoice.com, great place to see and hear not only this show, but shows from the past. You can see, get in touch with past guests, everybody who's been on the show, and Podclips.io. If you haven't gotten into your podcast groove right yet, it's a great place to go to start, and they have a lot of unknown but very good podcasters, whether it's in the finance world, health world, whether it's in lifestyle, sports. There's all kinds of different ways by which that particular website or Podclip Center. How do you get to it? It's podclips.io?
That's correct. Or
okay.
Podclip.io.
Podclipsingular.io.
Or
okay.
both.
Either one or the other. Check it out. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. And this is the Mortgage Voice. Yes, okay. We talked a little bit in the first segment about expectations in the marketplace and what you as a buyer are going out there to try to do. You want to get a house. You want to get the house at the cheapest price. I get it, but it's very difficult right now because we still see house prices rising, and we still see unemployment at pretty low, even though we've got some specter of unemployment rising as certain companies, like a bunch of us in the mortgage and banking world, have already seen layoffs from a number. We've seen 2 or 3 companies go out of business. Reasons they go out of business is obviously the refis are down 70, 75% from what they were a year ago. So companies that were in that business obviously aren't doing the same volume, and if they had huge overhead and you can't get out of it, guess what? You go out of business. Another reason some of these companies went out of business is the fact that non-QM market. Now, we talk about it a lot, and we're going to talk about it today and have talked about it. This is a non-traditional loan. This is what they used to call subprime, although that has such a bad name, even though that is kind of what it is now. These are non-government-backed loans. These are private money loans. They're not hard money loans. They're institutional lenders, but they're more like hedge funds and Wall Street and insurance companies. People that have money want to lend it out and then take that loan, bundle it with other loans, and sell mortgage-backed securities, either locally on the market in terms of where they sell those, the bond market, or they keep them internally and just service the loans. All of those are things that are available. But one of the reasons why companies, or a couple of companies in particular, went out of business is because when the market turned, now the market has turned. Anybody in the banking business who doesn't realize that, well, I'm telling you, the market has changed. Lending is tighter, the money is not as easily accessible, and purchasing of those loans goes under a great deal of more scrutiny than they used to. Companies would make a loan at a certain rate. That rate would not be available 30 days after it was locked. 30 days after it was locked was when they're trying to sell the loan. Because there was no market for that particular rate, they couldn't sell the loan. So those particular companies that had that issue went out of business or stopped doing loans altogether and just focused on their service portfolios. These are changing times in the mortgage business. How can you take advantage of a time when mortgage interest rates are going up? Well, if you're the type of borrower out there and you need a non-traditional loan, you can still get that loan. The key to getting the loan is the monthly payment. Make sure you're focused on how much during that month. Now, non-QM loans have prepayment penalties. Make sure that you get a loan that does not have a prepayment penalty. A lot of states on first mortgage liens make it illegal for you to get a first loan with a prepayment penalty. But if you're refinancing cash out, or if this is a different kind of loan in a state that allows it, that prepayment penalty can be up to 3%. Now, usually it's 2 years, 3 years, 5 years. That's what the prepayment penalty is. And who knows what the mortgage interest rates are going to be at that time, although I do think after the recession, or if there's a recession, which I believe we will probably have at least a mild recession in the next 12 to 18 months, what we will see is when we're coming out of it, or when you want to stimulate it, they'll lower interest rates and we'll have another real estate refi boom. That seems to be the pattern over the last 25 to 30 years that I've been in the market watching it, whether it's the dot-com boom, whether it's, what happened during the Iraq War when Greenspan lowered the actual interest rates huge so that you wouldn't pay attention to what was going on overseas. And of course, recently during COVID, same thing happened again. Now, it's happened several times, but those are a couple of 3 big ones that actually had happened. All of these things that I'm talking about today affect how you make your decisions. How you make your decisions are all, personal. You either sit around the kitchen table, you make up your mind on your own, you go to your financial person and try to figure out what the best way for you to take advantage of any particular market. So there are pockets in the U.S., and we talked about them several times in the past, that the real estate prices have come down somewhat. Let's just go to a local market, Las Vegas, Nevada. Now, we've seen Las Vegas, Nevada at its worst times. After 2008, 2009, 2010, we saw prices go down there almost 65 to 75% in some cases. Matter of fact, it took 4, 5, 6 years for a lot of those property owners to come out from underwater, i.e. they owed more than the property was worth. Since that time, we saw a boom in real estate market in Las Vegas. It became one of the fastest rising prices in the U.S. in terms of price growth. And we had, for the first time ever, a median price in Las Vegas maybe 12 months ago at about $430,000, which is really amazing. When you were talking about during the recession 8, 9, 10 years earlier, it was approximately 150,000. Normally, Vegas is not that kind of hot market, but it did turn into that this time around. So we've seen a doubling of properties on the market in Las Vegas, and we've seen the median price for properties in Las Vegas actually fall. I talked to several people I know who do flips out there and also wholesale properties. They tell me that the properties themselves are selling, but it's taking longer. 3 months, 3.5 months versus what it was 10 days, 15 days. Now, does that mean that Las Vegas is a bad investment because property values are lowering? No, I think this adjustment that they're talking about in Las Vegas is happening in a lot of places. It's happening down in Albuquerque, New Mexico. It's happening in Southern California. It's happening in Charlotte, North Carolina. It's happening down in I know down in Florida because we've done 2 or 3 loans there through Malibu Funding, the sponsor of this show. Their NMLS number is 79620. They also have seen falling real estate prices in that part of the country. There are some pockets, there are abilities by which if you have cash, you can make your offer a little bit more sweet. Now, earlier in this show, we talked about not doing things to hurt yourself and the regrets that some of the people who have been in the market have bought houses and now are saying, hey, I wish we hadn't done that. This is the time by which you go conservative. If a property is something you absolutely have to have, yes, I guess I understand it. But don't get fooled. Make sure that you and your agent or whoever it is that's representing you in the purchase of a property, make sure that you are negotiating with your best interests, not just the fact that you need to get this house. And the reason is as I said, we're going to see a readjustment in prices, and we're going to see 10, 15, 20%, especially in markets, like I said, in Las Vegas. I'm not the only one saying this, by the way. If you look any of these websites, whether you go to housingwire.com, you go to Mortgage News Daily, you go to CNBC, you go to MSNBC, you go to MSN, you go to even Yahoo. Go to these finance portions of their websites and read down until you see what's going on in the real estate market, and you'll see what I'm talking about. Everybody is talking about how the real estate market is going into a recession. Now, what does that mean? It just means that this adjustment that we're talking about is real. It's not something that isn't going to happen. If you can postpone your purchase, if you are the type of person who needs it right now, I get it. Everybody needs to get it. And if you can afford it on a monthly, yes, it's a good buy. But if you can wait, you can buy that property cheaper. And buying it cheaper is probably to your best interest. If we see more layoffs or at least that particular unemployment number rise, and we'll get to that by the end of the month, it'll be opportunity time probably in 90 days after that. I'm Jeff Barton, your voice in the mortgage industry. I appreciate everybody who's listening to the show all the time, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.